Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trading. One of the things that we're trying to accomplish over there at Tackle Trading is to bring you scouting reports. We call them scouting reports because obviously we're a sports-themed trading site. Take control of your future, get in the game, tackle trading. Scouting reports are a part of that. And the scouting reports that we have right now, we have the Forex report, which I bring to you guys every Monday, where I analyze all the different currencies out there. We also have the options report that Gino brings to you every Saturday evening, where he's talking about the option trades that he's making that week. Noah Davidson's going to be bringing you the equities report in time. The stock, we'll call it the stock report, and that's basically a report where Noah will be talking about the stocks that he's trading out there, whether it's he's trading in the stock or he's trading the option on it. But he'll bring you his best picks, and Noah Davidson is one of the best technicians around. So I'm so looking forward to Noah's report. So I pretty much never have to scan again because I'll just be using Gino's options report and Noah's stock report. And the last report we're looking to bring to you is a commodities report. Commodities are very, very important, and this is the inaugural commodities report that Coach Tim will be bringing to you guys every Thursday of every single week, and in doing so we'll analyze all the commodities out there, not just the gold and the crude and the silver, although that will definitely be part of it. Now, really briefly about what the commodities market is. The commodities market has been around for centuries now, 2 centuries. In fact, back in the 19th century is when this market really started forming, and it was basically formed around the farmers out of the Midwest who are farming wheat and corn and those types of things to find sellers for their goods. They would basically bring a bushel of corn or wheat, and they'd bring it into Chicago in the 1840s, and they would basically find dealers who would buy their corn or their wheat or whatever commodity that they were producing, and then the dealer would then buy it at a certain price, and then the dealer would be responsible for sending the commodity, sending the wheat, the corn throughout the entire United States, put them on the trains and put it out there to the United States. So basically what you had two different participants in here. You had the farmer, who is the seller, and then you had the dealer, the exchange, who is the buyers, and then they would basically agree on a price. Now, what this evolved into is basically throughout time, basically, is, let's say the farmer sells the dealer a bushel of corn, and basically the dealer then owns this corn, but they don't want to actually take ownership of it, so they would actually sell that contract, a futures contract is what it was called. They would sell that contract to another dealer who wanted to, and there'd be prices that would be guaranteed and whatnot. Or let's say that there was a contract being traded on it, and again you have the dealer, and then you had the farmer. So the farmer sells basically a contract to sell corn at $15, for example, and then they decide at a later date, well, I don't want to sell my corn at $15, and so they would exchange that contract to another farmer who would then basically have an exchange there as well. And that's where this market kind of evolved from, is just these farmers and the dealers there in Chicago trading the contracts to buy and sell different commodities at different prices. And the truth is that's still how the market works now, in terms of a lot of farmers using the commodities market, the futures market, to hedge against risk and whatnot. For example, let's say you have a farmer, and it's currently April 1st. So you have this farmer, and the farmer says, I'm gonna sell you wheat at $10, for example. Okay, and I'm going to sell it to you at $10 in June of this year. But the farmer expects the price of wheat to go down, so they're going to buy a contract today to sell that wheat at $10. So if wheat then goes down to 7, 8, $8, $7, $6, $5, for example. Again, this is just a hypothetical scenario. If the farmer then, if it goes down, the farmer still has the right to sell the bushel of corn or the bushel of wheat at $10, thus protecting themselves. Or let's say you have an airline. You have these airlines, and one of the number one costs for an airline is the cost of oil and the cost of gas and whatnot. So you have this airline who basically sees oil trading at, let's look at crude oil real quick, sees oil trading at 49.65. Well, they're going to, and let's say their analysis is oil's going to turn around and it's going to go up to $65, for example, by the end of September. Well, if that's what their analysis is, what the airline will do is they'll go buy contracts in September on crude oil at $50 today. So in September, when September comes and it's trading at 65, they still have a right to actually buy crude oil at $50, which means they've offset the rising costs. And so how farmers and airlines and businesses, how they offset costs is they actually go out there and they trade in the commodities market by buying and selling these contracts at different levels, and then those contracts can be traded around. Now, that's not historically how we do it, although I do expect that there's some farmers out there and some people with businesses who basically deal in commodities, and you can start looking at doing the exact same thing based on the analysis we bring in the commodities report. But also, we actually do this a little differently. We are primarily speculators in the commodities market, which basically means we are buying and selling commodities based on what we expect the market to go. We buy and sell commodities if we think it's going to go up, going to go down, and we're in essence back in the 1840s, 1850s, we're acting as the dealer, and we're basically buying and selling and exchanging these commodities and just profiting in that capacity. So we treat this market a little different as a speculative market. But what I hope the commodities report really gets to is not only from a speculation, but also to educate people on how other entities use this market so that you can start utilizing the market as well. Tim and I, for example, we grew up in farming communities. We grew up in coal mining communities, and there's a lot of farmers who have went under that we know of. And one of the reasons why they went under is simply because they didn't understand the price action and how it works and how they can hedge themselves. And we know a lot of farmers around the world that could utilize this education and knowledge to help their actual businesses. And then obviously we like to just go make money in the commodities market as well. So we're going to look at the commodities, and again, this will evolve in time, ladies and gentlemen. There's a lot of commodities: wheat, soybean, oats, corn, silver, sugar, palladium, platinum, natural gas, cattle, lumber, coffee, copper, lean hog, gold, cotton, sweet crude oil. There's a lot of different commodities out there. And so in time, as you guys get accustomed to watching the videos on the commodities report and reading the reports as we start to really kind of evolve the commodities report, that you'll kind of let us know which commodities you really want us to focus on. And obviously gold, silver, crude, those are going to be some mainstays in what we look at. So let's quickly just kind of identify the trends and the bias to the commodities out there. This is the wheat futures. Wheat futures currently is in a neutral formation, trading between 475 and 529. So that's wheat futures. That's ZW. ZS is soybeans. Soybeans is also neutral right now. You have oats, which is bearish. And so let's say, for example, you have a trader out there that sees this kind of movement. It just broke down out of a support level at 266. It's currently trading at 261. This is probably going to go down from here. And so if you have as a farmer out there who has contracts to buy, oats at 280, there's no reason to own that contract anymore. You would want to sell that back to the market, because the price of oats is probably going to go down in the future, and that's another way kind of how people utilize it. Corn futures kind of tracking a little bit of neutral right there. If you look at the weekly chart on the corn futures, you see a little bit of decreasing momentum from this level to this list, kind of finding support levels there around the $300 level. It'll be interesting to see what corn does in the future. You have SB, which is sugar. Once again, very bearish here, looking for sugar to pop from about $12 right there. I look for sugar to come back up into the 13.4 range. So as a speculator, what I would do is I would probably buy sugar right here, sell it back to the market as it came into resistance. Platinum right here, bearish downtrend with a bearish retracement. Looking for that to confirm at the 1160 mark, coming back down. You could short that one. Here is Palladium. I know Tim kind of likes to say the word Palladium. We like to trade it. Big breakdown right there. Bearish trend starting to pop back up, looking for it to come back up into the 70-60 mark, and then you could short it in that 70-60 mark. Natural gas is in a neutral range here at $2.60. I look for that neutrality to kind of continue in looking at kind of the ranges of natural gas. The last time it got into this 260 range, it was all the way back in October of 2013. It hit a low point of $1.90. If natural gas ever does get back into that $2 range, I think that's a wonderful opportunity, and obviously it came into the highs last year at the 650 range. So I still see a little bit of pressure on natural gas, looking for it to come down into the $2 range eventually, but for right now that is a neutral sideways trend, and you have UNG that tracks natural gas in the equities market that you could trade, that you could sell put options on to profit in that capacity. Here's live cattle for you farmers out there. This is a head and shoulders formation. This is a kiss of death. I am looking for the cattle prices to go down from here. And so another thing, one of the ways farmers could go about hedging themselves is not only to, buy future contracts to hedge against it going up, but what if it's going down? Well, the farmer out there, to protect the valuation of their business, they could actually go short live cattle. And so as live cattle came down, they're obviously what they're receiving for delivery of cattle is going to be less, but they're going to make up the difference in shorting the future contract here on live cattle. Then you have lumber, which is coming all the way down, and it's going to continue to come down, and that's another thing builders could do, is actually short this to offset cost. Coffee is turning into a little bit of neutrality. Heating oil futures, a little bit of upward support levels right there. I am going to call that neutral there. And then you have the copper futures, which is now in some degree of bullish uptrend. So what was down is now up. This is a nice little bullish retracement right there. Upward, downward, upward, downward. And so again, what you could do is, in copper dealers, is you could buy the commodity right here at 275, and then as it tracked back up into 305 range, you would sell back to the market, always getting in and out of different types of positions. Lean Hog, just because we like to say Lean Hog coming into resistance at 62.31. Look for that to confirm and continue going down. This is a really good bearish channel on Lean Hog, and if traders will do anything, ladies and gentlemen, it is to short Lean Hog, because let's just face it, it's kind of fun to short Lean Hog. Feeder cattle, this is very similar, and then we come with the granddaddies of them all: gold, silver, and crude oil. Gold here, I talked about this week earlier in one of my videos. I was short gold right here, so obviously I did not like today in any capacity. But any one random day in the market, anything can happen. I still am slightly bearish on the commodities. I see a little bit of neutrality from a intermediate cycle range, really kind of tracking since back over here in October. So the last 6 months, kind of just going neutral. But if you look at this short-term price action right there, this short-term trend still is downward. However, if it does get back up above this 1215 level, I will be getting out of my short position on crude. But right now I'm still slightly bearish on gold, and I've been some degree of bearish or slightly bearish on gold for about 3 years. Here is your silver. Silver in a very similar capacity, very neutral over the course of the last 6 months. Short-term price action, even short-term price action, a little neutral here. And given it was down, very similar to gold, but unlike gold, silver actually got back up above this level. Now, from a long-term perspective, gold and silver are used to protect against fiat currency, protect against hyperinflation, and whatnot. And I just absolutely love silver from a long-term perspective. I know there's some short-term pressures on it in terms of the overall trends over the last 3 years, but I am a big fan of silver. I like the ratio of silver. I like the technological usage of silver, and right now I love selling put options on silver so that if it actually gets put to us, we can cash flow and exchange our money for a commodity instead of a fiat currency. And then the granddaddy, who everybody loves to talk about, this is crude oil slash CL. Crude oil right now, it was bearish. Okay, it broke down this level, and you know what? I did say that was bearish. It pivoted right back up. That is neutrality. Naked puts galore on crude oil is what I'm looking at. I don't think you can take a directional position until we see some degree of breakout. There's still some massive, massive macro risk out there in the marketplace when it comes to what the Sauds are doing against the Syrians and the Iranians and the Russians and the shell drillers here in the U.S. They still control this overall cycle, and you know, it would not surprise me in any capacity to see crude oil a year from now into the 25 to 30 range. I've seen some projections in the 20 to 22 range. I think that's a little low, but you know, nothing would shock me with crude oil. All I know is this: the technicals are king. They are neutral right now, which means naked puts, those types of scenarios, good cash flow strategies, deep out of the money. Maybe not on crude on this actual contract CL, but maybe it's USO, which is the United States Oil Fund. Hope you enjoyed the inaugural commodities report. Obviously, we're going to continue to build this commodities report the same way we did the options market, the same way we did my Forex report. And so if you have any suggestions you would love to see on the commodities report, let us know over there at tackletrading.com. Check us out over there, get in the game, and start making your life a little better one trade at a time.